In our previous videos, we learned a great deal about profitability ratios, liquidity, and solvency ratios. I hope you can make use of at least some, if not all, of these numbers to read between the lines and do your best to pick a stock. Today, let's talk efficiency ratios and market ratios. Efficiency ratios are very important because they tell us how good the company is in making use of its resources to generate income. For example, let's talk about inventory turnover ratio. It is a proportion of the cost of goods sold to the average inventory. Cost of goods sold in this case is the inventory at the beginning of the period plus any purchases made. Let's say the inventory at the beginning of the year is worth 20,000 rupees. By the end of the year, it's worth 50,000 rupees. The average inventory is the business spent an amount of 70,000 rupees on the cost of goods sold. The proportion of cost of goods sold to the average inventory is 2. This means for this year the business sold and replaced its stock 2 times. It is better to have a good turnover ratio because it indicates the ability of the business to convert its inventory into cash more often. In other words, the business is turning its inventory into cash every 182 days. These are called days in inventory. So days in inventory is the number of days on average that the company holds its inventory before selling it and making cash out of it. There is another ratio called the accounts receivable ratio, which is a ratio of the net credit sales to the average accounts receivable. Say the business made some sales on credit for 100,000 rupees, of which the returns amount to 10,000 rupees. The net sales this business did on credit is 90,000 rupees. The accounts receivables at the beginning of the year is 10,000 and the end of the year is 20,000. This means on an average the receivables is 15,000 rupees. The ratio comes to 6, which means for this year the company is able to get its receivable bills paid roughly 6 times. In other words, the business is getting its bills cleared and getting cash every 61 days. 61 days in this example is nothing but days sales outstanding, or what is fondly called as debtor days. Similarly, we have accounts payable ratio where we divide the net credit purchases to the average accounts payable. This ratio is of interest to us because we want to see that the company is paying off its suppliers in time and hence not losing on its important suppliers. Now, how do we calculate the average accounts payable? We take average of the beginning and closing values of the accounts payable. Net credit purchase refers to the total value of the purchases you got from your suppliers during this period. Now, here is the ratio. This means the company pays off to its suppliers every 2 times during the year. In other words, it takes 182 days on an average for the business to pay its suppliers. Let's discuss the last section of the financial ratios, that is market ratios. Market ratios are pretty common. EPS tells us the net earnings of the company calculated for each share. Say the net profit is 100,000, the number of shares outstanding is 1000. EPS or earnings per share is. If you want to know about EPS in a simple and easy to understand language, refer to my video. PE ratio tells us how pricey the stock is in relation to the earnings generated by the company. If the price of the stock is 400 rupees and the EPS is 100, the PE ratio is 4. For every rupee of the earnings per share the company is generating, how much is the share price you are paying? Based on a comparison with PE ratio, we have a ratio called PEG ratio, which tells us the price you are willing to pay for 1 rupee of EPS and 1% expected growth in earnings. If you want to know about the basic concept of PEG, here is my video. Book value per share is the total equity value. Remember, we discussed about equity? The equity value calculated for each share. Based on book value per share, we look at ratios like price to book value, meaning the market price of each share in comparison with the book value of each share. A stock with high price to book value in comparison with other stocks of the same sector means that the stock is overvalued. Dividend yield tells us the dividend given for each share in comparison with the market price of the share. I hope I have given you some basic idea of what financial ratios mean and how these numbers help us get a sense of the business. Our next video is going to be a very important video. We are going to do a fundamental analysis of Rain Industries Limited. We will try to do a thorough analysis not just with these financial ratios we have learned over these 3 videos, but also the outlook, risks and opportunities of the segment that the company is operating in.